So the breadth is favorable. The market is now almost at 21,000, another 70, 80 points here and then 21,000 on the Nifty. Adani Group stocks, they continue to gain weight, and you've got banks which are really giving it some company. Small cap stocks, after 2 days of, splutter here and there, a little bit of chop and churn, they're also back on the screen, so to speak. So just 77 points more, and then it could be a print of 21,000. Any large newsmakers post the market? Nothing large. Macquarie analyst meet on Asian Paints. There is a note from CLSA on auto downgrade, but that's about it. I guess the mood point is still that there's a FOMO crowd which is now forcing itself to jump back into the ring, so to speak.
Yeah, just looking at some of the other names, let's see what Patanjali is up to. That could be definitely one stock on our radars. They're looking to grow the premium segment. They're looking at expansion in southern India. So that's the takeaway really coming in from the investor meet yesterday. Asian Paints, Nikun just flagged off. Macquarie's reiterated a double-digit volume growth. The expectation for second half in the next 5 to 7 years is pretty strong. That stock holds up 1.5% as we speak right now. Bank of India, it's a sizable QIP which opens today, 4,500 crore rupees. That stock starts off with a move of nearly 2% in trade. And Power Grid, which has turned out to be a successful bidder to establish interstate transmission system projects. So look out for that stock as well. CLSA, by the way, has downgraded some of these two-wheeler names, Eicher, Bajaj, Hero, TVS, saying that the stocks are now fairly valued. So Eicher may be seeing a red tick, Hero is just marginally higher. TVS should come up for you on your screens next, and I don't think there's any material move or red tick rather coming in on these names. What's Honasa up to? Fireside Ventures, remember, yesterday was a seller in that near 2% block, and Norges Bank was a buyer with an 0.8% stake. So look out for what this stock does. Oberoi Realty as well, they've completed one of the payments to NRB Bearings for a land parcel in Thane. So look out for what that stock does. There's of course Pharma too. There's a licensing agreement with Aclaris that they've gotten into. About almost a 1% uptick is what you're seeing on this particular name. But let's just look at what some of the private banks are up to and where this move in the Nifty is really coming in from. So I can see Axis Bank is absolutely flat. Let's see what ICICI Bank, HDFC Bank are up to. 0.5% to less than 1% actually is the move on these stocks. ICICI Bank is absolutely flat. Is it Reliance? Let's see the intraday graph of that stock. That will just come up for you on your screens. HDFC Bank, of course, has made a decent start. Reliance as well is a lot more tempered in trade. ITC, the Adani names, they're the ones which are flaring up ahead. Kunal, what trades are you punching in right now?
So I think ICICI Bank looks attractive from the banking pack, and I think the stock yesterday did pretty well, moving up above that 1,000 mark, and I think also towards its fresh highs. So would look to buy the stock even if there's a mild correction into the stock today.
Right. And Naresh, your strategies?
So that would be a buy on Maruti, which is setting up for a breakout into new all-time high. So this could go test the 11,300 mark in the short term.
Okay, just looking at the market texture, and let's just revisit some of the big movers from yesterday. So Adani Enterprises, Adani Ports, ACC and Ambuja, they were the ones which were really ruling the roost in trade yesterday. Kunal, as a sector, or as a segment or a cluster in the market, one of course can see the Adani Group names, they continue to hold out. But outside of this pocket, do you see any thematic or sectoral outperformance kicking in?
So sectorally, I think Bank Nifty as a larger group looks attractive, especially the underperforming ones, the private sector names. Most of the other sectors, for example, realty has played a very good comeback from the October lows. I think up more than 20-25% from that kind of a price band for themselves. The IT, of course, has been an underperformer, but I believe that maybe over the next few weeks, we may see better levels to try and buy or time the IT names. Auto stocks are going through a bit of a consolidation. They have not yet given a big breakout, and I'm talking of most of the underperforming names. I think the likes of Maruti, for example, Tata Motors is also getting into a bit of a stagnant zone around the 700 mark. So I think there is a pocket within these performing sectors which also could do pretty well for themselves.
Okay, Kunal Naresh, we'll see you again later in the show. It's a good start, definitely. And we're now counting down to the 21K mark on the Nifty. But the large street has really been on a tear ever since the state election results came in. So let's hear out some of the biggest market voices and where they believe the market is headed in from here. Hear it out from Madhu Kela, Hiren Ved, Safir Anand and Tahir Badshah.
It gives kind of a certainty for 2024 election. Significantly that there will be, continuation of the same party and the same policy given the election results which have come. And considering that, inflation has been very stable, interest rates have been very stable, currency has been very stable, and there is no major volatility in any of the front, right? And the fiscal situation of the government is also very stable. So this all points towards, more higher valuation than what we have seen in the past.
There is still an opportunity. While the small and mid caps in general and the broader markets have done phenomenally well over the last 6-9 months, I think the large caps in general have lagged. And so I think investors want to participate. I don't think we've reached those absolute bubble valuations. How can we talk about bubble valuations when until recently your Nifty was for 2.5 years was largely in a consolidation phase?
Fall is the GDP data, which has now caused even the rating agencies to upgrade their estimates for India. It was far ahead of expectations. The second is the turnaround that is happening in many PSUs. I heard our petroleum minister speak about 50,000 crores profit in BPCL, and there has been so much of skepticism around owning of these companies because they've not seen as profitable companies and more of dividend plays, but that's completely changing. The next is the return of FIs, and I think that is going to be a big catalyst for the market. Many people make a statement that the retail is the only element in the market that matters. Retail has caused us to reach where we are. FIs will cause us to move ahead from where we are. I personally feel that the stability of the government will cause them to be able to pass more bills in the parliament.
Growth prospects, which are definitely better than most of the rest of the world. And alongside which, what we are also witnessing slowly and steadily is the stability of the currency. The rupee has behaved a lot better and has been, depreciating a lot lesser than what it used to in the past. We have seen about a 4% depreciation in somewhere between 2005 and 2013. And in the last 10 years, it's been more like 3%. And probably with the initiatives that we are currently on with, if we see a relatively better stability in the rupee compared to versus the dollar, then I think that will probably add to the, more positive sentiments as far as foreign investors are concerned, whether it is FDR or FII, or whether it is equity or debt markets.
All right, Gautam Shah joins us. Let's take our conversation forward. Gautam, post the state election verdict, everyone is bullish. What we are measuring is the extent of bullishness. So my first question is that history tells us that markets have always moved up in the run-up to the election. There are 4 instances in last 20 years. So if one works with an assumption that this time it's no different, what to your mind could be the best case scenario for Nifty in the run-up to the elections?
Well, I think in terms of best case scenario, it's an open sky right now because you are at uncharted levels and you really don't know how high this market can go to. And having seen the 2003-2007 bull market, I for one don't want to really project numbers on the upside. I'm very happy to understand the trajectory. I don't need to know the magnitude. I think the market will tell us, from time to time. But I think the key takeaway for me in the last 6 weeks is how the markets handled the headwinds. Let's not forget in the first week of November, there was a scenario where there was concerns around interest rates, there was concern around geopolitical factors, and there was genuine concerns around what will happen the assembly election results. These three major headwinds have been contained really well in the last 6 weeks, and that's probably the reason the market has discounted the same and come back very strongly. And not to forget the domestic liquidity angle that really helped the market sustain at lower levels. So I do believe that this breakout that took place, past 19,850 and then a 1,000-point rally is likely to take the markets higher. But at this point, as we speak, we are a little overbought. There is madness on the screen. There is madness in a lot of stocks and sectors that could lead to a bit of a pullback, but the overall trend is likely to stay strong. And I think if you really look at it from a medium-term perspective, our working target as a technician, even though, as I said, numbers don't matter, but 22,300 is now our working target from a medium-term perspective. And this area of 20,000, which has been such a big barrier for 2.5 years, could now be the new base. I think that's really the biggest takeaway coming from the activity of the last 2-3 weeks.
Okay, that's the target right now from a medium-term standpoint for the markets. But I want to understand what the view is on some of those banks in particular, Gautam, given the fact that we have seen a pretty heady rally over the past few trading days. What's the best case scenario pre-election over the next 6 months or so for the Nifty Bank Index?
The market never looks strong when Bank Nifty underperforms. And that was the case for the last 3 months. If you look at what Nifty did, it was a very tentative looking rally. There was not much leadership. Reliance was not doing well. Banks were obviously not doing well. And IT index was in a bit of a difficult spot. But with this comeback of the Bank Nifty, I think the scenario has changed completely. The screen is looking a lot more vibrant. It's good to see the top stocks move in line with the Nifty and lead the Nifty. So this is a very good space because you always want the Nifty and Bank Nifty to go hand in hand. And with this breakout of the last 4 days, it does seem that the underperformance, which was there for 2.5 months, has ended, and now banks can actually continue to lead the market higher. Our working target for the Bank Nifty, now it's not too far at 48,000, so that's an inflection point. I think we will get there. But the key takeaway is some of these top stocks, SDFC Bank, ICICI, and particularly SBI, which we really like at these levels. I think they could see a special move over the next 3 to 6 months. So some focus from the mid caps to the large caps is definitely getting shifted, as most of your competitors might be talking about, and that's our view as well.
Right. Gautam, there is also that entire debate in the market on whether to reduce exposure to mid and small caps right now, because that's where the froth is now building up, and whether tactically move allocation higher to large caps because they're the ones which have lagged, and of course, the safer lot as well. Do you think that kind of distinction needs to be made?
Selectively, yes. I think large caps, cannot beat mid caps and small caps in terms of percentage return. You might say that they might do better, but then in terms of percentage moves, I'm pretty sure that mid caps and small caps still offer great value. Let's not forget the 17,000 crore or 16,000 crore pie that is coming into the system every month. A lot of it is now going into the mid caps and small caps. So what we are telling our clients and subscribers is to stay with top quality, stay with mid caps and small caps that have institutional interest, because let's not forget, in the last 1 month, grade D and grade E have also done well. Everything is being painted with the same brush, and there are Excel sheets out in terms of earnings visibility for the next 10 years, which I don't think is a little fair to assess at this point of time. So top quality mid cap, small caps, the top 100 small caps is where the action will continue, because it's getting a lot of money, it's under-owned, and there is a lot more room on the upside. And clearly the India story is playing out through those 200 stocks, the top 100 mid caps, small caps. So large caps, yes, could do well because there could be a bit of a catch up, but don't ignore the mid caps and small caps, and don't reduce significant allocation there.
Quite interesting there. So where are you finding value still within mid caps, and where do you think there are more legs to go?
See, there are newer themes, coming up every single day, Aisha. I think if you look at fertilizer, it's a space that we have liked in the recent past. And I think there are some big stocks which are coming out of long bases. So whether it's a Chambal fertilizer, GNFC, GSFC, Deepak fertilizer, I think this is an entire space that we like. We are also a big bull on sugar. I think we've recommended a few stocks there. Awadh Sugar, Balrampur Chini, I think has great potential from these levels. Dalmia Bharat. I think all of these stocks have potential. Not to forget power. I think JSW Energies of the world, Tata Power, CESC, look at the move that stock has seen after years. And I think that's happening in many, many pockets in the market. Infrastructure obviously is a great story as well. And among the large caps, I think IT and pharma, for me, from a risk reward perspective, offer a lot of value. I think pharma could be in outperformance mode for the next 6 months. All the top stocks, I think, can deliver anywhere between 15 to 20%. And IT, I think, if you want a little bit of stability to your portfolio in the madness, in the craziness that's there in the market right now, I think IT, top quality IT, offers great value as well.
So what happens to the runners of the market? Let's say power, defense, because see, for something to go higher, something has to make way. And for somebody who's got limited capital, I mean, the audience, what we have got them here, either is fully invested or they have limited capital. So they have two options: stay with power, defense, don't do anything, or switch out. What is a better strategy?
See, I think it depends whether your time frame is 5 years or your time frame is 6 months. Because, we've seen so many stocks in the last 1 year that they complete their cycle and then just go into hibernation mode for the next 6 months. And newer stocks are participating. Look at the comeback in ITC. Look at the comeback in SBI. Look at the comeback in L&T. All of these stocks were doing nothing for the last 3 to 6 months. Power, I think, is a big structural story. Power, real estate, for me, are big structural stories. I've been a big bull on it all along. So you simply stay invested and don't look at day-to-day moves or day-to-day corrections. But defense and railway, I think it's very, very overdone at these prices. And if somebody got in really lower and is not looking at 3 to 5 years, take some profits, move to newer sectors.
Again, we go back to that same asset allocation model. Your view is that don't meaningfully change your exposure to small and mid cap stocks. Now, there is a bit of a dilemma here because capital ultimately is limited for everyone. So if you don't switch out of mid and small cap stocks, and if large cap stocks offer a higher momentum proposition and greater margin of safety, so then what? Put more capital to work, leverage your portfolio. That's the only way you can perhaps buy them if you're not selling something.
Well, even if you don't want to put more capital at work, or if somebody does not have more capital at work, you should still stay with the mid caps and small caps. As a technician, I look for outperformance and underperformance. So when I look at the ratio chart, which is the mid cap index divided by the Nifty, that is at an all-time high. Don't understand mid caps in absolute terms. Look at mid cap index in relative terms versus the Nifty, and it's at an all-time high, and there is clearly a lot more room on the upside. So I think this mid-cap, small-cap outperformance is not going to end till at least elections next year. So I think that's the big opportunity. I know everybody's talking about large caps being a catch-up trade, but even if it's a catch-up trade, I don't have visibility beyond 10, 12, 15% in many of the large caps, but I do have a 15, 20, 25% visibility in many of the mid caps and small caps. So it's really a tactical call which one has to take. Some of the larger fund managers, larger players in the market like the large caps, but somebody with limited capital should stick to mid caps and small caps.
I say Tata, everybody will think goodbye. But from a market standpoint, Tata has been like a wealth creator group. From Titan to Trend, from Indian Hotel to Tata Consumer, some of these stocks have just hit out of the park. Now, how would you approach Tata Group of stocks? Now, it's a very isolated question because it's a sector which they represent. But guess what? With the exception of 1 or 2 Tata names, all Tata Group of companies are trading at P multiples which are highest in their respective sectors.
That's okay. I think that's a value unlocking which was long overdue. They always deserved a far greater multiple given the fact that they come from the Tata brand. So I don't think you really can say that because they are at such high multiples over many years, they should be sold into. And I think we prepare a lot of custom indices. So when we prepared the Tata custom index, we realized that it actually broke out of a 6-month consolidation a month back. And you must have seen the kind of move Tata Power has seen, Tata Consumer has seen in the recent past. Tata Steel also seems to be breaking out. I think, this is a group which is pretty much a no-brainer. If you have to play the India story, if you want to participate in the markets aggressively, you just have to stay invested. There will be phases where it might not do as well. So be it. I mean, you cannot play this market 2020 on a daily basis. But as a long-term investor, Tata Group is clearly the best proxy to play the India story.
The most obvious names that one is pegging at within large caps are, HDFC Bank, Reliance, ICICI Bank, ITC, I'll skip Infosys out of the list, wherein they have the maximum weightage and the bearing on the index, and they're still quite a distance from their all-time peaks, both in terms of valuations as well as price action. Are these the names you're also tilting towards within the large caps?
Not really, Aisha. I think it's over-owned, it's over-researched, and just because it hasn't done well in the last 3.5 months, I think a lot of people are hoping that they do well because then the underperformance comes to an end. But I do believe that instead of an HDFC Bank, I would rather go the SBI way. I think SBI can beat some of the other private bank returns over the next 3 to 6 months. That's the bet that we are taking at Goldilocks, and we in fact even put out a recommendation a couple of days back. But the other top names, Reliance, HDFC Bank, ICICI Bank, ITC, L&T, as you mentioned, they will be market performers. There will be times when they will do well. Also, let's not forget we live in a synchronized world. This entire rally has been short covering driven. And once that short covering gets over, which I think is getting over at today's prices, I think things will go back to normal, and all of these stocks will go back into a range. So they might have done well, but don't expect them to do something special over the next 3 to 6 months.
Gautam, really appreciate your time. Thank you for joining us. Can we get that graphic out? Kunal's Nifty target before election 25,000, most bullish there. Nuresh was 22,500. Himang Jani 24,000, and I think Gautam's given us a target of 22,500. So everybody's of the view that markets in the run up to the election will see a rally. If history is anything to go by, it's not a very myopic data, but it's a data which is at play. They say history does not repeat itself. Well, in this case, it's rhyming. Last 4 election cycles and 6 months ahead of election cycle, markets have a run up. And looks like this time it's no different. So why do markets always go up ahead of election? And what happens now that everything in the world seems to be aligning in our favor? Let's take that conversation forward with Mir. Mir Vorai joins us. And Mir, वो कहते हैं ना कि नक्षत्र सारे एक साथ आ गए, नवग्रह. Everything has come together for us, right? Macro globally is getting sorted. Flows are back. Political risk is getting nullified, and valuations are not stretched. So, Navgrah aa chuke.
And macros back home also.
Absolutely. It's a Goldilocks.
Yeah.
It's a Goldilocks situation. More in the sense that we had global headwinds, which are now turning neutral, I would say, in the sense one must realize that there is no harm in being a little cautious because the global headwinds are turning neutral because there is a chance of a slowdown in the US economy. So the way the bond yields have corrected in the US it's what's driving the emerging markets. So to that extent, it's kind of good news in the sense that the world will slow down, but not sharply. That's the Goldilocks situation. But we have to be a little cautious because we are talking about a slowdown where you can see some import on exports, some impact on exports, etc. So for India, I think it's a good situation to be in where you have moderating global interest rates, a not so strong dollar, and not a crashing global economy. Inherent strength of the domestic consumption should carry us through. Plus the Capex cycle, which is just picking up, should see us through the next 2 to 3 years, I would say.
So what would it spell for equity markets? Are the levels that we're currently at pretty much around the peak? Or do you think there's significant headroom to go up until 2024 elections?
I think at the large cap index level, there is still some scope for upside. Though I'm not very comfortable with the speed of the rise recently. But there is scope for upside, I would say, because markets never peak out at average valuations. They always peak out at 1 to 2 standard deviations above
so 5%,
average. So
10%?
we still have 5 to 10% of, I would say, valuation buffer before we reach those stretched kind of numbers. I would be a little more cautious on the micro cap and small cap space because there the velocity is too high. And then I think we should be more discerning on stock picking.
And you did speak about the Capex theme as well. So is that an area where there is value? If you could just be elaborate a little bit more?
Absolutely. So in Capex, of course, there are some fancied sectors like now it's become fancied defense and railway, etc. But there are also the traditional ones like construction, which are not that stretched. So if we do believe that we are in the midst of a good long-term revival in the real estate cycle, for example, which is just beginning to pick up, then I think there's a long way to go for some of these construction stocks because they are not that stretched, I would say.
Mir, they say markets always climb the wall of worry, but they come down on ray of hope. And there's a lot of ray of hope right now, which means our market's building in a lot of cheery consensus.
No, I think at least till 2 days ago, there were a lot of skeptics.
Okay.
And there was a lot of shorts in the market. If you see the FII net shorts, they were huge. So I think a lot of the movement in the last 2-3 days you are seeing is a lot of short covering, not only by domestic speculators, but I think to a greater extent by FIIs. If you look at the index net shorts, they were almost at record level still about 10 days ago. So that covering itself is, propelling the market. So I wouldn't say we are in a euphoric zone yet.
Why do you say that?
Because this is just the short covering. We haven't seen long build up yet.
Yeah.
Okay, now let's look at the valuation matrix. We are at about 17-18 times depending on the research report you follow. 17-18 times is in line with the averages. If you are looking at market return when markets are in line with the averages, what has history taught us in terms of next 3 to 5 years in terms of future returns?
I'd say about 12% is what one should expect from these levels. If again there is no global shock or anything
Of course,
like that. Yeah, absolutely.
Okay, so you should be having a positive frame of mind even if you are starting today.
Yes.
Let's say somebody is watching those shows, says, okay, I've seen Mir Bhai on ET now, I'm convinced that there's no bubble in the market, I'm starting investing in large cap stocks.
Absolutely.
You think that a 12 to 15% return is something which is a high probability case, it is not like a out of blue event.
Absolutely, because if you look at the rolling returns history, there have been very few instances where 5-year rolling returns are negative, and almost nil when 10-year returns are not that great. So the longer you kind of take a call, the surer you are of your returns.
Okay. So maybe
In
you
fact,
talked
sorry,
about-
just to
No, go ahead.
in fact, I also did a study on long-term returns. If you had invested at all the peaks, so if you had invested at the peak of 2008, or if you had invested at the peak of 2000 and still waited for 10-15 years, the returns are not that great, not like 14-15%, but they're still 8-9%.
Yeah.
Category,
Oh yeah, 2008. What was the index level? Nifty, the peak.
Absolutely.
No.
It was hardly like okay, 8,000.
Nifty was about sub 10,000.
Sub 10,000.
8,500 or 9,000 you
exactly.
peaked out and you
Yeah,
almost
so you're
came.
still sitting on a decent
Exactly.
return.
But that's the nature of the market, Aisha. I mean, look at the peak of TMT versus the return by the time 2008 bull market peaked out. Peak of the next peak, in a sense, I would say happened somewhere in mid-cap stocks in 18. From there to now, that's the nature of the market because the economy is expanding, GDP is expanding, so that is at play.
The base continues to bloat
base is
up.
expanding.
But you talked about construction. Where are the other pockets of value right now?
I think the banks and financials are still undervalued, considering that we are in a Goldilocks situation, low NPAs, credit picking up. So far, it's only been retail, but now even corporate credit should pick up. So there's a long runway of credit growth with a clean balance sheet, under leveraged balance sheets for the NBFCs also. I would say financials do offer a lot of value. Some of the insurance companies also offer good value because they've also underperformed for quite some time. And even asset management and capital market plays, for example, we have seen AMCs underperform because of I would say margin issues or concerns about future margins. But I think that also seems to be stabilizing. So there are pockets of value in financials, I would say. And the other underwrote, other underwrote sector is pharmaceuticals. I think we're just beginning to see the cusp of a recovery, a structural recovery in the generic bulk drug and API segments. So there, I think exports should now again become the story for the next 3 to 5 years.
IT services continues to be an avoid.
Avoid in the sense it will come back to its old growth rate of 10 minus 1 or 2% kind of a thing. I don't see secular. So if you're bullish on the domestic recovery, domestic capex spending, then this will be more of a defensive, like a mature FMCG stocks.
Any niche areas that you believe that there is some value in the markets?
Well, they were niche till a few months ago. Now everything's
Defense.
Yeah, absolutely.
Yeah.
Defense, railway capex, those kind of names should continue. And I think manufacturing itself, in general, we just scratched the surface. India is 18% of the world's population, but 5% of the world's manufacturing. China is 11 times bigger than us. So even if 5% of world production has to shift to India, it means a doubling of the base. So these mega trends can last for a while.
I read this lovely piece from Akash Prakash yesterday that don't rule out China, right? We're on one WhatsApp group, you must have read that also. Now the thing is, we are on one common WhatsApp group.
You better add WhatsApp.
So my point is, Mir, we are assuming that FIs will come back. That's a big assumption. That's one big fat assumption. That's an assumption.
Yeah.
And there's a difference in assumption and reality. What if they don't come? What if they find China more attractive? What if they say, okay, we missed the bus too bad, but the relative case of coming back to India now at these levels of 21,000 plus is not there? Could that be a dampener for next year's liquidity setup?
To an extent, yes. But if I were to compare India now versus India 10 years ago, there are two huge structural changes that have happened. One is that the oil import bill for the trade deficit or the oil import bill is no longer that much a percentage of GDP as it was, right? Because oil imports have not gone up that much, but the GDP has expanded. So oil sensitivity to the GDP has reduced because services exports have boomed. You know, it used to be $100 billion. Now we are $240 billion. So we are far bigger in terms of services exports, which is reducing the volatility of oil. Yeah. So yes, there is a current account deficit, but it's lesser and much less volatile than what it used to be. So our external vulnerability to oil has reduced significantly. So that's one. And second, again, as we all know, compared to 10 years ago, look at the domestic flows.
Yeah.
The other thing, Amir, I just wanted to talk about, since you're talking about manufacturing. Now, manufacturing is a very large umbrella within a lot of subsectors in there. And I'm going to keep the obvious defense, railways outside of that. EMS is a theme. Do you not worry that it's still very shallow a space to invest in and the discovered names have already run up too much?
Yes, to some extent, I would say that. But again, you know, there will be more companies coming for listing in this space. You typically see, you know, India is such a diverse country and such a diverse economy, and we really have a thriving ecosystem of entrepreneurship. So any sector, for example, which you know comes to the limelight, you suddenly realize that there are hundreds of smaller companies which were already there doing stuff. Yeah. It's just that now they are coming to a certain size and IPO able, so to say. And plus, to some extent, for better or worse, you know, the fact that we have now the SME exchange, where the listing norms and disclosure norms are, you know, not that stringent, is making easier for some of these companies to raise 2 crores, 5 crores, 20 crores, you know, that kind of thing.
Interesting. So you're prompting my next question in terms of, you know, you spoke of a thriving startup ecosystem as well. What about some of the recent listing? I think there's been like some 40 that we've seen in this year, and there's been Tata Tech, a lot of commendable names. What is your take?
I think it's a function of the market, and it's good in the sense valuations, if they get too stretched, is also not good. We need paper supply to come in to, you know, douse the fire, so to say. I think it's good. I was just talking to somebody, there were 150 IPOs this year, including the SMEs and all. So it's good.
And that's where you can sense the FOMO feeling.
Yeah.
Literally. Looking at the...
I mean, to some extent, people are not really analyzing the companies. They're just looking at the grey market premium and investing. But it's life. It always happens like that.
There's a lot of friends there.
Okay, Mir, really appreciate your time. Thank you so very much for joining
us. Thanks for having me.
And thank you very much. There is a little bit of, you know, shakeout from the top, just a minor skim from the top, but that's par for course. I mean, Thursday, Friday, the run-ups been so strong that a little bit of here and there cannot be ruled out. We are still below 21,000. Like 60, 70 points on a base of 20,000, frankly, really does not matter in terms of the market setup. Let's take a break. When we come back, we'll connect with the management of Borosil. Shiva Khiruka joins us, Managing Director with Borosil, and let's first understand the big picture, how life has changed after yesterday's spin-off, and now Borosil shares are trading ex demerger of the Borosil Scientific Limited. Shiva, good morning. Thank you for joining us. Just explain to our viewers that why did you decide to spin off the business, the current entity, what is trading right now, what does it have, and what are growth prospects?
Well, thanks for having me. We have two businesses in Borosil Limited. We are the consumer products business, which are basically kitchen and table products, and which is the brand I think most consumers are familiar with. And we have a scientific products business, which encompasses lab, glassware, laboratory instrumentation, you know, process systems like for chemistry, flow chemistry, and so on. And we found that most investors were either bullish or on one or two, or on one or either of the two segments. So we figured that it made sense to split the companies into two, as you know, they have two totally different outlooks in terms of growth, in terms of you know, the capital we need to kind of drive into the business, as well as the return expectations. And we see both the businesses growing well, and therefore, it was the right time to split the two.
There's always been a glassware company, and I'm talking about the consumer business here, but now you're venturing into new consumer durable categories. Consumer durable is a highly competitive market. It requires a lot of upfront investment, and return ratios are not the fantastic. Why are you looking at diversifying into what could be called as a mass product category?
Well, you're right. In the past, Borosil was a glassware. In fact, the company's name was called Borosil Glassworks Limited. We changed this back in about 10 years ago, and since then we've considered ourselves as to be a consumer-focused company, and we will make products and deliver products to the customer as per the needs of the customer. So customer centricity has become really our focus. In that regard, we find that we have many customers in many areas of the country where we were not able to reach because our product was not relevant. And that was when we came up with the idea for expanding our product range. While you rightly mentioned that the appliances, the home appliances, etc., is very competitive, but we have been able to have a mass premium position here, and with the quality we offer, with the service we offer, the return expectation is more than justified by our expansion into these new markets. We also found that by getting to these new geographies or these new product categories, we've been able to expand our core glassware offering into areas where earlier they were not really available. So there has been a healthy kind of knock-on effect from these products onto our core glassware and our opalware range as well.
Okay, fair enough. So that is about the two business, but let's discuss the consumer business in particular. What about demand in terms of how it's panned out for Q3, considering we've had the festive season as well as the wedding season? Do you think that growth will come majorly from volume or from value?
Well, I think Q3 certainly the Diwali was a good one, and we had robust demand across all areas. We have many channels. We sell through trade, we sell through e-commerce, we sell through large format stores, and so on. And we saw a fairly broad-based growth in demand across the channels, and we're quite satisfied over there. And the demand was the growth was volume driven. We've not taken any price increases in the last few months. So all the growth we've seen is more or less volume driven, which is quite encouraging for us.
All right. That's the view coming in. So if I may just drag that question further, the first half for FY24 saw a 15% growth. For the second half, do you think it'll be better than the first?
Yeah, well, I mean, I'm not going to comment on quarterly numbers, but in principle, we've always forecasted a medium-term growth rate on our consumer business of between 15 and 20%, and I think we'll be at the higher end of the range if I look at the short to medium term. And on the scientific business, we forecasted a growth of between 10 and 12%. Here also, I think we'll be on the higher part of the range in the shorter term. But if I look at a 3-year window, I believe our consumer business can look at maybe doubling revenues every 3 to 4 years. That's really the broad outlook.
Okay, what about the scientific division? I wanted to understand there as well. That saw some pressure when it came to margins last quarter. Is that pressure only going to continue, or are you seeing a pickup?
Well, actually, the core range of products that we have in scientific is actually doing very well. The pressure is really coming from a lot of investments we are making in R&D, and these are, I would say, very good investments for the long run. So yes, they do look like they impede the margin in the short run, but I believe that the new products we're developing, we've got a big team of engineers. We really believe that India has a lot of design and engineering capability in this area, and by investing in that, let's say, talent, we've been able to develop products which are really world-class. And these products will definitely drive margin improvement in the quarters and the years ahead. We don't really look at business from a quarter-to-quarter perspective. We have a longer-term view. So the margin depletion in the last couple of quarters is, let's say, a blip in the journey for that division.
Okay, good to hear that. Tell me what's happening about the Capex, your 625 crore rupee Capex, which was planned both for the consumer as well as scientific business. What's the status on that?
Well, we've almost completed the entire cycle. Our last plant is going to be commissioned, I think, in January, the first week of January or the second week of January of 24, and that will conclude the capex cycle. Out of the 625 crores, we finished 525 or thereabouts. About 100 crores of capex we have deferred because we had thought of this during COVID when supply chain challenges were very, very pressing. And now those challenges have since depleted substantially. So about 100 crores we have deferred that capex, but the balance is all.
Okay, fair enough. Give us a sense as well in terms of the increased competition, because that from the smaller players, from the unorganized sector, all of that, particularly in the kitchenware category, is picking up. Is anything worrying you? Are you confident about maintaining your market share? What strategies are you using to alleviate competition?
Frankly, there's always been competition in these segments. So I don't see, it's not just a direct competition directly for glassware or directly for appliances. We have a lot of substitute products also, which are used in the home, in the kitchen, and on the table. So competition has never been something it's not something new for us. And I believe that we have, we focus on our own offering, and we focus on our conversations with our customers, and we keep differentiating our product and driving value. So competition was always there, will always be there, and I don't see the intensity of competition changing, in either direction. So it's a very large market, and I think our brand offers a certain promise to our customers, and if we keep doing those things correctly, I believe we can grow at the rates that we have already forecasted, for a long term, for a long period of time.
Sure. Good luck with that, Shrivar. And we'll chat again soon. Thanks for taking the time out.
Thank you.
Okay, that's the word coming in from the Borosil management. We're going to take a very quick break. Let's just revisit where the Nifty has settled in at so far. About 88 points higher on the futures right now. We're above the 21,000 mark, at least for the futures, and still about 75 odd points away on the Nifty spot, but above 20,900 there as well. The contributors, LTIM, Wipro, TechM, it's actually IT which is seeing a bounce. Who would have thought? ITC also holding up in the green as we speak right now. Asian Paints, Nestle, TCS, and guess what? Reliance is up nearly about 1.5%. So that's definitely a big contributor to the market move today. We'll take a very quick break. When we come back, we'll have the management of Anupam Rasayan join in.
Thanks for staying on with us. Let's keep it with corporates and find out what the outlook is as well when it comes to the chemicals industry. The pricing pressures weighing down. What is the outlook when it comes to demand? Vishal Thakkar is the Deputy CFO at Anupam Rasayan and now joins in on the show. Thanks for taking time out. So to begin with, Vishal, I wanted to just get an overall outlook then on the chemical sector as a whole, because I understand that there are some concerns right now with respect to destocking that could end soon. But there has been high competition due to the recovery in China and the China oversupply impacting a lot of branded and generic sales. Can you give us a roundup?
Oh, hi, good morning. Thank you, and great to have a chat with you. On the market side, yes, it's been the demand has been the industry has been seeing a bit of a headwinds there, especially what you rightly found out that, suggesting that destocking is an issue. Yes, the channels have had a little bit of more inventory than what the market was comfortable with, and the industry is unwinding that. That is pushing the demand for the backstream guys a little further to by a few quarters. Yes, China is coming in, and that also is reducing the kind of market supply, increasing market supply and reducing the demand for the industry. If you look at in total, I would say that probably by that large part of the whole pain has been through, and I guess in next quarter or two you should be able to see something moving back to a more normal growth that we have been seeing in the past as well. So I think yes, there has been a bit of a blip for a few quarters. Probably we might say for a quarter or two, and then we should be back to the growth story. That's what I think we are seeing as an industry. And for Anupam also, if you see, I think we've been fairly flattish to little on the upside on the growth. Probably this quarter also will be kind of a similar, and in the Q4 of this financial, we should start seeing the growth back in our journey as well.
Why do you think things will improve?
Yeah, that's where we are.
No, why do you think things will improve? What will change in next 2 quarters?
So I think 2-3 things are happening. One is the channel destocking that we have been talking about is fairly at the fag end of the process. So that is one thing. Two is whatever was the high level of China, which had stocked up a lot of their produce, and they were not able to do business for last 2 years, largely because of the zero COVID and the restrictions in the supply chain. I think that all should also unwind in next quarter backs or two. So that are the two things. If you look at from a demand perspective, I don't think that there is a secular destruction of demand in this industry. Be a agrochem or a pharma or any other secular demand destruction has not happened. It is only the moving of the playing of the inventory up and down is what has been the real factor, and that's what the Indian suppliers have been really focusing on, which is where they are a B2B guy, like an Anupam is a B2B to, let's say, a European player, and that's where you would see that there is a bit of a push going to the quarter 3, quarter 4, and quarter 1, quarter 2 has been flattish for most of us.
As an industry, would you have visibility as well? Because we were reading a couple of analyst reports, and they are actually pegging the overall sectoral recovery, demand recovery per se, to come in by FY25. So would you concur with the same view? And this is not just Anupam, I'm talking about the overall industry.
So you're right. See, if you see what even I said in my opening statement as well, if you really see, I'm saying quarter or two. So if I just put it to 2 quarters, let's say, then we're talking about FY25 in any case, and that's what everybody is talking about. So see, it will depend upon which part of the value chain you are. You are in the fag end of the value chain, or the starting of the value chain, or you are into base chemicals, or you are into finished dosages. Will determine that when does the demand pick up. But largely, it's right that probably 1-2 quarters and you will start seeing the demand, and that's what I think the analysts are also talking about FY25. I think that's where it looks like, and that's our understanding. And I think the analysts know better than us, I would say.
Sure. We were just chatting with Tata Chemicals as well just the other day, and they highlighted some of the challenges, especially in the European market. Now, Europe has been a big market for you as well, with more than, I think, 1/3 of your revenues coming in from that geography. But you've been on a signing spree with some of the Japanese chemical companies of late as well. Is that an intentional shift owing to the slowdown in Europe? And do you see Europe as well as a geography recover anytime soon?
So first is, I don't think it is about that we were seeing headwinds in the Europe and hence we moved to the Japan, because see, the business that we are in, typically what we see as a culmination of an LOI or a demand is an effort of 2 to 3 years, and not probably over the last 6 months or 12 months of effort really is the case. So after the acquisition of Tenfac, and if you look at the strengthening of our team in Europe, in Japan and in Americas, so there are 3-4 things. One, if you look at 7 years or 8 years back, my Japan revenue was 0. I am around 15% of my revenue now. And that is only a momentum getting created in that geography. And that is what is happening for Japan. And same way you will see that Americas will come into play. America, especially North America, will come into play. And that also will have a similar kind of a behavior as we go further. So I don't see that it is because of that Europe, we were concerned about Europe and hence we moved to that. It's just that we are broadening our market, and this has been happening structurally for last so many years, and that is only continuing. Europe, I would again say that if we see the manufacturing in Europe has been a bit of a challenge. That's true, but see, at the end of the day, there is large capacities, especially for the formulators and for the brand owners and the market, and that we don't see that is going to go off significantly over the near term period. Probably there will be a lot more of offshoring happening, and that's probably the opportunity for countries like India and China, which will really be taking the advantage of the offshoring that would happen from a branded guys to to which they were typically doing it in Europe to, let's say, Celtigos and Lanxess and all, which will come to probably to companies like us and to our peers and the industry here.
Why are global companies like BASF and other European European chemical makers revising their guidance downward? I mean, they are the guys who got capacity and who really have a hold of the market.
So you are saying that are they not revising, or have they revised?
No, they've revised already. My point is that why are they? I mean, the fact that if they revise their guidance, they are talking about a bleak scenario beyond 6 months. Otherwise, they would have not revised it down.
No, you're right. I'm not saying no to that. But let's say that BASF has revised the view by, let's say, 15%. Let's say. I'm just giving an example, right? Now, look at it from that. Where were they sourcing from? They were also sourcing from Europe itself, and also from China and India's, right? So now the demand, the sourcing from the Europe itself, from cabs and cameras and fine chems and Lanxess are going to be significantly impacted because they will have the least of the competitive strength here in terms of pricing situation, right? And if you look at on the net basis, is where I'm saying that probably we will have an advantage to really grab that market. And at some time, at probably, let's say, not even 6 or 12 months, but that market will come back, maybe at least at or to similar levels. And that's where probably companies like India and in companies in India and China will be of an advantage. And so I'm just trying to differentiate between originator or brands which are like BASF has guided down. But if you look at Lanxess has guided down significantly compared to the BASF, right? And that is what we are trying to say, that that's where there will be a wedge that will come in for companies like us and the Indian peers of ours. Yeah.
Is that good news for you, bad news for you? Because it can have interplay both ways. Because when crude goes higher, I've seen that everything in the chemical sector goes higher. When crude goes down, everything goes lower.
So I will say that what will happen is that the companies which are more having their robust supply chain first, because that really helps them in terms of defending their whole value chain. That's one. Two is companies which are more likely wanting to work on a long-term basis and not trying to talk about today's price or tomorrow's price. I think these are the ones which will eventually have better advantage, because that's how the Europe has been behaving. If you look at all the relationship of a European supplier to, let's say, BASF or a Syngenta, is pretty much more like a long-term behavior, and they are looking for a long-term supply chain solution. So companies which are really focusing on that whole supply chain, long-term partnership will have, because I don't see, at least this is my personal view, and I'm willing to be corrected in future, but I believe that the end production market or the capacity of the BASF, I don't think we are going off anytime soon enough. Maybe there will be a dip, maybe there will be corrections, but eventually there will be the demand that is there, and they will need suppliers which are more agile, more robust in terms of the supply chain, and are able to give them a pricing solution which helps them compete in the world. So I think that's where we would say there is an opportunity, and you're right, there will be a bit of challenge. I'm not trying to say that there is no challenge or there is no risk, but I think there is a fair bit of opportunity that will come in. I don't see that it's about a quarter, 2 quarter, but if you look at it structurally, this will continue to be a very interesting market for players like us and for players in India as well.
Okay, great having you on the show. Thank you so much, Vishal, for taking the time out.
Thank you.
Okay, let's move on and let's discuss what's happening with the market. Still counting down to that 21K mark, much unlike the GIFT Nifty. While the futures, of course, have already made it to that level, still some time to go before the spot Nifty as well gets to that mark. But let me take it across to Kunal, find out what are the chartbusters that he's been spotting. Kunal?
Thank you, Aisha, for that. So it's a mid-cap name. It's Parag Milk, a stock which I think over the last many months have done reasonably well, but somehow over the last 1.5 odd months, the stock was getting into a sideways or a tight consolidation. But the interesting bit for stock on the medium-term charts is the breakout the stock had seen. So this is 2020 odd phase for the stock when it went through a correction. There was a rally from levels of 50-55 for the stock price, came back towards 100. Sharp degree of volatility, as you can see. These are swings of 50% for the stock price move. But the moment the stock had broken past about this level, which was the previous major resistance high, on the back of some extremely strong volumes. We term this as a price volume breakout. We've seen the stock moving up higher. In the last 1 or 2 months, as I said, that the stock was going through a very tight kind of a consolidation. This generally is considered to be a healthy consolidation because after such a steep run, the indicators get overbought. So a time-wise consolidation generally leads into a good entry point for the stock price. So I think closer to 220, 225, where the stock has been trading, it's an attractive buy, expecting the stock to scale past about the immediate levels of 250 and then hopefully crossing about the previous highs of around 350 plus for the stock over the medium term.
Okay, interesting. That's Parag Milk Foods on Kunal's radar. Naresh, what about your chartbuster idea?
So that's a chart for Maruti, which has given a breakout on the last 5-year chart, wherein the stock had made a top around that 9,500, 10,000 mark in 2018, 17, 18. Then in 2022, 2023, a couple of times it tried to test that, could not do so. Finally, over the last couple of months, a breakout is done. And after making an initial move to 10,800, it's taken a pause, retested the 10,000 mark, and now is setting up for a fresh breakout. So a good risk reward trade here, a stop loss at 10,400 and a target price of 12,500.
Okay, and let's get in some stock specific trades too, Kunal.
So I'll go with 2 buy calls. From the larger cap front, TCS is something which I highlighted in the morning, looks attractive for a target of 36.50 from current levels. Traders could look at a buy. Stop loss could now be trailed higher to almost 35.10 for the stock. And on the other name, from the mid cap end, EID Paris, something which is heading towards a breakout. So would suggest a buy with a target of 600, stop loss 540.
Okay, and Naresh, what about your stock ideas?
So first is a buy on Infosys, a small breakout here, stop loss at 1440, target price of 1550 for the next few sessions. Second is a buy on Coromandel, which continues in momentum, stop loss at 1200, target price of 1350.
Now we'll take a very quick break. In fact, come right back. We'll have the management of Gokuldas Exports join in on the other side.